All right, good morning, everyone. Hope you had a great weekend. Today we have a guest speaker, Craig. So he is with Assumption Solutions. We've had the topic come up numerous times about, hey, I see this property. It says they have an assumable loan. Can we do that? How do we do that? So today we have a specialist on to go over the assumption process and also some services that they offer as well. Good morning, Craig. How's it going?
Excellent. Thanks for having me.
Awesome. I'm going to stop my share. All right. So, yeah,
Uh,
do you want to give us a quick intro on what you do and how you got here?
Yeah, sure. So, my background actually, I've been a realtor myself since October of 1995 when I was a 19-year-old kid. And I've spent a lot of time sitting at closing tables with buyers in our market, which is heavily VA, and the topic of the assumable nature of the deed of trust would come up. And I always had said, hey, if we ever found ourselves in a rising rate climate, that they would have a special asset. I just didn't realize that it would be like 25 plus years before the rate climate would change, but it did change dramatically in 2022. And so a partner and I saw an opportunity and we created a company in 22 called Assumption Solutions, which I think we kind of invented an industry, truthfully, at the time. And now we're at the forefront of it. We've probably been involved with more assumptions than anybody in the nation at this point. So that's where we're at. And I spend a lot of time with this company training agents all across the United States. I love real estate agents, being one myself, and I know what we do best and what we need to know and what we need to focus on. And so, yeah, I do a lot of this exact kind of training.
Wait. All
So,
right.
if you want, I'll go ahead and share my screen now and
Yeah,
I'll just dive right in. All
let's
right.
let's dive right in.
Okay, share. Okay, so we should be good, correct?
I can see your screen, so we should be good.
All right, sounds good. So, obviously, we're going to talk about the VA and FHA mortgage assumption here. Now, I do like to throw in a little bit of humor because Zoom calls can be sometimes a little mind-numbing here. So bear with me if you can. If you don't laugh, it's okay. I won't be offended. Interest rates, when bottoming out, is a good thing. How low are interest rates on assumptions? Well, sometimes they're as low as this guy's truck. I was very proud of myself because I actually took this picture and made this meme when I saw it in a Home Depot parking lot. But the lowest rate we have seen processed to date was 1.75%. I think that must have been out there maybe for 24 hours or something. But rates are generally that we're seeing as far as attractiveness, generally below about 3.5%, which most of those rates were issued, the lowest rates were issued between March of 2020 and March of 22. After about March of 22, they started rising pretty dramatically above 3.5%. So, anyway, all right, let's move on here. We'll talk about our agenda first. So, we'll do a mortgage loan assumption overview. We'll talk about the assumable loan types and eligibility. The value of a loan assumption is where I'll nerd out a little bit on numbers. The assumption process steps that you need to go through, whether you're helping a buyer or a seller. The pricing we charge to assist in the process. We'll talk about changes we've seen in the evolving market since 22, because this is a dynamic space and things do seem to always be evolving. And then I will take off my Assumption Solutions hat and I'll put on my realtor hat and I'll talk about closing more deals, how to get more buyers, how to get more sellers, how to properly market a listing when you get it, and then some of the resources that have come into the marketplace to help you in this space. All right. A mortgage loan assumption occurs when a buyer agrees to take over the existing loan of a seller, becoming responsible for its repayment. The two types of assumable mortgages are qualifying and non-qualifying, but non-qualifying is basically gone. It sort of ended in the late 1980s. Now, when I got licensed in 1995, we occasionally still see a non-qualifying assumable come up in the MLS system, and we'd run out the door and try and buy it ourselves. Because basically, all I'd say is, sure, you want to make a deal with me? I'll take over the loan. That doesn't exist. Now you have to meet the same qualification standards as the original borrower when they took that loan. You must qualify for it. Nearly all qualifying assumed mortgage loans today are either VA or FHA guaranteed loans. I will do some caveats to that. We have a section of our company that helps people do assumptions in the case on conventional loans in the case of a divorce situation. When there's a divorce decree, once soon to be ex-spouse can assume it as long as they qualify with it with the servicer and the servicer's willing to do it. They do not have. There's nothing in the deed of trust that makes them do that. And that's the only situation we've seen with conventional loans being assumable. And it's not universal, it's not across the board. You may have heard that USDA loans are also assumable. We're not seeing those at scale because there's truly some questions as to whether the seller of the home is actually released from liability. So we're just going to focus on VA and FHA guaranteed loans. Now, VA loans can be assumed by both veterans and non-veterans alike. However, only when the assumption is made by another veteran with sufficient VA entitlement would the original borrower's entitlement be released from the loan and the new buyers will be substitute on. So if you're going to market a home that has got a VA loan, you really need to talk to the seller and make sure they understand how entitlement would be affected if they don't sell and allow another veteran to buy that home with sufficient entitlement. They must have sufficient entitlement because if you think of entitlement kind of like a dollar range, let's just say 800,000 bucks. It varies by region, but if they've got a $400,000 loan on them and they want to do an assumption, right? They must have the ability to do an assumption that's below the remaining entitlement that they have. You can't buy bonus entitlement when you're doing assumptions or anything like that. So for sellers, if they're willing to leave their entitlement, it gives them a bigger market, of course, because it's open to non-veterans. Not everybody is a veteran, but it may reduce or eliminate their entitlement that they have left to use in the future until that loan is paid off. Doesn't mean they have zero if they leave some entitlement behind. If they've got enough cash coming out of the sale and enough remaining entitlement to do another VA loan, they can. So keep that in mind. I tell agents, don't pigeonhole a seller into what they should or should not do. We see probably 3 to 4 in 10 of the deals that we're involved with go veteran to non-veteran. The main reasons we see this happen, there's really 3. Number 1 is the seller might be a little advanced in years and has no plans to use the VA loan again. So they're okay leaving it behind. The second reason that we commonly see is there's 2 spouses with VA entitlement, and they just decide to use the other spouse's entitlement in the future. And the third most common reason is they just get down to whatever the heck gets the house sold. And so they're okay leaving it behind, or they feel like they have to leave it behind just to get the deal done. So keep that in mind when you're talking to parties on both sides, buyers and sellers, with regards to VA assumptions. Now, FHA loans are also assumable, but they do not involve any entitlement issues like VA loans. They do, however, require that mortgage insurance be paid with each payment for the entire duration of the loan. With VA, mortgage insurance is a premium that's done upfront, but not as part of the payments. With FHA, it is there for the life of the loan. But when you look at the comparison between the rates of the assumed loan versus the rates of a new loan, often even with mortgage insurance, they're saving quite a bit of money. So now both VA and FHA loan programs are primarily intended for owner-occupant purchasers. However, I'm going to address some changes to that in the evolving market slide. All right. Now we're going to go on to the monetary value of a loan assumption. This is the the numbers nerd in me. My favorite slide here, and I've got four columns that I'll talk about, and each has different great information that really you want to master to be able to provide to your client base to grow your business. So first we'll look at a payment comparison, and we'll look at a $400,000 loan at a 7% interest rate, which equals a monthly payment of $2,661 versus a $400,000 loan at 2.75% interest, which equals a monthly payment of $1,633, which equals a monthly savings of $1,028 a month, or an annual savings of $12,336 a month. I call this column the headline numbers that really gets people interested in doing assumptions. Everybody out there would love to save money on their mortgage payment. And this is really, really a great number to understand how to put in front of clients when they're evaluating property. Now, next, we're going to look at the purchasing power comparison. Really, what this is about is the affordability crunch that we have seen in the marketplace since 22. All right, that monthly payment of $1,633 equals a $400,000 loan at 2.75 or a $245,000, $500,000 loan at 7%, which is a decrease in purchasing power of $154,500 to keep the same monthly payment. So that means the purchasing power was reduced to 61.4% of its previous level. So everybody feels this. We feel this as agents. Clients feel this. This is why transaction volume has decreased across the United States, because it's an affordability crunch. So that's what we're all dealing with. Now, this next column is the column that the truly savvy people financially are focused on. This is where the wealth is built over time, and this is an interest saved over time. So total interest paid on a $400,000 loan over 30 years is $558.36 at 7%, or $187,868 at 2.75%. Now that is just interest. That's not the principal, right? And that's equal to an interest savings over 30 years of $370,000 and change. That is massive interest savings here. Now we're going to do a little exercise for the rest of this column. We're going to assume that the property goes on the market 3 years after that loan was issued, and somebody comes along to buy it and assume that mortgage. So in the first 3 years that mortgage was owned by the now seller of the home, the interest that they paid was $31,938, right? Interest is front end loaded in amortization schedules. So the first years you get the biggest amounts of interest that are paid. That means when they assume that loan for the next 27 years, the interest savings that they will realize in total is $402,106, which is actually $2,106 over the original loan that was taken out at $400,000. When you understand the power of this and the power of the savings over time, it's unbelievable. It actually kind of frustrates me that I just didn't buy every house I could have ever bought at these low rates and keep them forever. But when you want to get clients who are wealthy to work with you, you show them these kinds of numbers, they're going to get very interested in doing transactions. Now, the last column we'll talk about here is a deal we actually processed that I never had thought about until we went through this. And this is older loans with higher interest rates. So this house that went on the market, it had a $500,000 loan originated at 5.29% in 2009 and a payment of $27.73. The remaining loan balance 15 years later in 23 was $358,759. That's the amount that could be assumed. So the home went on the market at $900,000, and that had an assumption gap, which is the difference between $900,000 and that $358,759 of a little over $541,000. The buyer of this home had sold a home in Hawaii and had that in cash and went to assume that loan. Now, the interest paid by the seller over the first 15 years was 336,421. That's just the interest they paid because it's front end loaded in the amortization schedule. That means the interest remaining to be paid over the next 15 years of the term was only $164,000. So just because the interest rate wasn't low doesn't mean that this isn't a great deal for people to come along and assume it. I would take this deal all day long. Matter of fact, if I ever find myself moving, I'm only going to be looking for something in this space. All right. Hopefully nobody's glassy-eyed in here now with the numbers. Now let's move on to the assumption process steps that you're going to go through. So the first thing, when you're working with either a seller or a buyer, you want to confirm that the property has an assumable FHA or VA loan, right? You want to review the existing loan documents carefully. All parties should pay close attention to the loan amount, the interest rate, and the payment. That is the asset that you're either going to be marketing as a listing agent or that your buyer is going to be purchasing. You don't want to hide that information from parties. One of the best things you can get is a copy of their most recent mortgage statement, which usually has this stuff on there. Now, you need to maybe pull an ownership and encumbrance report. Now, this is different in every part of the country, of course, but a lot of title companies can pull these. And what you're looking for is the deed of trust. It should carry an FHA or a VA case number on it that will confirm that it is assumable. If it doesn't have one of those, it's probably a conventional loan, does not have a qualifying mortgage assumption clause in it. All right. Ultimately, whether you're marketing the home or you're hunting for the home, you're going to execute an assumable purchase contract. Servicers who approve these, their assumption approval can take anywhere from 45 to 120 plus days, averaging 60 to 90 days. Now, keep in mind, this slide is rather old. I still keep these dates in here, but we're seeing quite a few servicers, especially over the last year, getting sub 60 days. We're seeing some as fast as 25 to 45 days. And still, I would say the average isn't near that 90. It's probably averaging closer to 60 now. The factors that affect this timeline more than anything else are number one, what are their internal systems? How many of these do they do? How much staff do they have? And things like that. And then the next thing is what is their caseload? What is their volume? Even the best servicers, which we track them all so that we can tell people if they reach out to us, what are we seeing in terms of an average for a particular servicer? We track them. But even the best ones who maybe are getting close to that 25 to 45 time frame, if they get 200 deals in a week, they're going to bog down a little bit. So you need to have a plan in place to be ready for a little bit longer time frame in an assumption than just the process of a new loan, right? Now, buyers need a plan for the gap between the purchase price and the loan amount. Usually, it's a cash down payment. However, I will address some changes to that in the evolving market slide coming up here. Flexibility and advanced planning are essential as the process may take time. One of the best things you can be doing is both you and the other agent are having conversations about like timelines of everybody involved and how this works and what to expect. This class you're going through right now is also going to be recorded on our website that we do that because we do this all the time. So if just because you're taking it, you might want to send a link to it to the other side of your transaction so they understand the process a little bit better. But be in a conversation with them. Understand that this is something you need to be flexible with. All right, now from here, as soon as you go under contract, this is what we hope you do. Send the contract to Assumption Solutions because our role is to be your easy button for getting through the assumption. So you can focus as a realtor on what you do day in, day out, and let somebody with expertise do the assumption side. We function as your assumption transaction coordinator, right? We'll vet your transaction to determine if we can help you be successful rather than you waiting weeks or months for servicers to review your submission. On average, the servicers take anywhere from 2 to 4 weeks to even look at a submission. That's a heck of a lot of time to be in a contract waiting for somebody to review something. we usually have a review done within 2 to 4 days, depending on how fast people get us what we require. If we come back and say, hey, we don't think we can get this done, that might be a good clue to say, okay, we're going to pull the plug on this deal because we do tons of these. I mean, right now we have nearly 100 files actually active and open across the nation, and we're rolling anywhere from 50 to 70 on a low month average. So we do a lot of these. We'll then help you navigate the submission to the servicer, ensuring that it's done right the first time, as errors will lengthen the timeline. Because if they review it in 2 to 4 weeks and there's errors, they kick it out, you got to resubmit. And oftentimes you could be restarting the clock because you go back to the back of the queue. So we'll keep you from abnormally lengthening a timeline with a servicer. Now, ultimately, the servicer issues assumption approval, not us. We are not lenders. We don't provide financing here. Assumption Solutions will then continuously and regularly follow up with the servicer to ensure they are moving the file forward. We help you understand the process at each stage and adapt as needed. If they come out with conditions, we help people get those dealt with as fast as possible. A lot of the servicers are actually pretty thankful when a file comes to them through us because we have many of them that know that it makes their job easier because they don't have to do as much legwork on their own with people who just don't understand the process, buyers, sellers, and agents. So the servicer takes in and processes the assumption application. Once they grant assumption approval and clear to close, closing can be scheduled from there. But timelines may vary, so once again, remain flexible. All right, now another little laugh break here. Hopefully you laugh. Navigating a complex process with experts, teamwork makes the dream work. So in this meme here, you've got a real estate agent, buyers before and after, and you've got three here who did not use you, let's say, as their agent. They started off okay, but by the end, they sure didn't look good. And the guy in the far right corner, well, he used you and he looks really happy that he did. We like to be this for you. We don't want you looking like any of these three folks in the upper left at the end of getting through an assumption. So come to us. We'll try to make your life easier. Now, to do that, of course, we charge a fee. Big shocker, like every business, we charge a fee. We charge each party a $950 fee totaling $1,900 per transaction, right? The first $50 though is all that is due at engagement from each party because our goal is to be low cost, low risk, high value. So if you look at a seller success fee of $950, a buyer success fee of $950. Now, regarding other costs to doing an assumption, the servicers themselves can charge a processing fee, but we find that it's often under $1,000 because it's kind of capped by the government entities. Now, on VAs, there is a VA funding fee of 0.5%, which is waived if the buyer has a qualifying VA disability. On FHA loan, there's no such things because mortgage insurance, like I said earlier, is part of the monthly payment. So at the end of this, though, in most cases, the assumption is a lot less costly than a new loan because you don't have the lending fees involved. And just on VA loans, your funding fee is significantly less than when you get a new VA loan. So keep that in mind. Now, I've got a little example here. Just there's multiple ways to break this out. Commonly, our fee is split half to buyer, half to seller. So that's the first example here. $950 to each party, upfront engagement fee, $50 to each party. Now, when assumption approval and a clear to close is issued, we invoice out the remaining $900 per side. We do not bill those at closing for two reasons. Number one, we don't deal with the closing department, and we found that when it moved from the assumption department to the closing department, they were confused when they were trying to balance numbers, and it was delaying closings and contracts were having to be modified because they just didn't understand who we were and what we did, right? So we don't want to mess your closing time frame up, so we don't bill at closing. The second reason is we also view ourselves kind of like a home inspector, right? We have a certain defined role in your transaction, and when we get to the end of our defined role, we bill out at the end of assumption approval and clear to close. We don't actually control whether or not the buyer goes to do a walkthrough and the house is trashed and they decide not to buy it, right? Our service is complete, so we bill out at that point. Now, if it's not split, that's fine. You can negotiate it however you want. You just have to notify us if it's not split, how you want us to do invoicing. So it can be paid by the buyer, the seller, or a third party. So total success fee of 1,900, 950 per side. Upfront engagement to one party would be 100. And then once clear to close is issued, 1,800 would be invoiced to whatever one party is making the last payment. All right, now let's move on from there. Let's talk about the evolving market and some of the changes we have seen over the last 3 years now. It's amazing to me that we've been doing this for 3 years, but time flies. All right, first I'll talk about is the changes to occupancy requirements. FHA loans must go to owner-occupant assumption buyers only, but VA loans can be assumed by non-owner-occupant investors. But there are some caveats. Number one, the most important, is the seller's entitlement will have to remain attached to the loan. They will not be able to do a swap. The buyer will not be able to purchase it in the name of an LLC or a trust or anything else. So they have to buy it in their name, even if they're going to rent it out. So the nice thing I think about that is going to keep out most of the large corporate entity investor type buyers. Now, the last bit there, I just will mention, be very careful that your buyers are honest if they're an investor or an owner occupant. You don't want somebody coming in and saying, "Oh yeah, I'm going to buy this as an owner occupant just to get the swap done or get the seller to want to do the deal or whatever," but then have the intention of renting it out. The the organizations, I think, are going to audit these pretty hard because they know this is so attractive. There's a lot of people who want to get these low rate loans, maybe as an investment property there. So keep that in mind. But we are seeing quite a few investor assumptions go on and come through our company at this point. So it is a big growing piece of the marketplace. All right. The potential of obtaining secondary financing. So when we started this in 22, we thought, okay, we're seeing big gaps out there between the price and the loan assumed. Is there a marketplace? And we started looking around for assumable, or sorry, for second mortgage products. And then, truth or rumor, I don't know, but it came out that to do an assumption with a second, the second would also have to be an assumable product, which did not exist. And that quashed the market for a good period of time. And then about August of last year, the VA actually issued guidance that said, we don't care anything about seconds as long as it doesn't mess with our position as a first mortgage. And so the second mortgage financing market has started to grow. We're not involved in it. We don't issue financing, but what we're seeing is the products that are out there are commonly purchase money HELOCs, and they are still requiring, in most cases, at least 10% down on the purchase price. So, for example, a $500,000 sale, a $400,000 assumable mortgage, that would be $50,000 down in cash and $50,000 down in a HELOC second and an assumed first to do the deal. There may be other products out there. There may be other things that come into the market space, but that's commonly what we're seeing. The seconds being a HELOC, usually it's a Fed fund plus a spread. So we're seeing the rates, I would say, between probably 8 and 10% plus that are out there. The buyers will have to be qualified on what they call a blended rate. The combination of the first they're assuming and the second they're taking will give a new payment combo that will come out to a certain rate. So they'll have to qualify on that as well. But it is a rapidly growing place in the marketplace because the average assumption gap that we see across the nation is at least 50,000. The biggest one we've processed and seen was a $2 million sale with $1 million assumption gap. Now, the seller had that million in cash, but there's opportunity out there. Now, the question then becomes, how big of a second does it take to no longer make sense to do both as an assumption versus just do a new loan? Obviously, if your second is smaller and your first is bigger, usually it's going to make sense. So, but there's all kinds of nuance to that you need to look into. All right. The handling of escrow accounts. I'm not going to spend a ton of time here. We're very used to in regular sales how escrow accounts go in a certain way. It's not uniform yet in assumptions. In some cases, what we like to happen does happen. In some cases, it's a little goofy because depending on the time of year that you close, maybe there's a shortfall in the account because the insurance was just paid out or the taxes were just paid out. The buyer's going to get a new insurance policy. The old insurance policy is going to go away. But at the end of the day, here's what I will say. Whatever the servicer decides is going to happen with the escrow account is kind of what everybody has to go along with. So keep that in mind. It could be a little bit different than you're used to. Now, the last thing here is something that is kind of a thorn that I hope the government agencies fix. And this is the VA eligibility restoration timeline for a seller who does a swap of entitlement to a VA buyer when they do the assumption. In a new loan, you can sell a home, your VA loan releases at the sale. You can go down the hall and you can literally buy the new home on a VA loan. It's very simple, bing, bang, boom. We've all probably seen it happen many times. But in an assumption, the swap, when the parties are swapping entitlement, it actually takes place post-closing. The guidelines from the VA are that the servicer has 45 days to complete the swap, and then VA has another 30 days to reinstate the entitlement. And I think that's partly because they're trying to audit the file to make sure it was done correctly and the swap is legitimate. This is ridiculous. That could mean you have 75 days between selling your home and becoming a new VA buyer. I hope this changes. There's no reason it should take that long. It's a legacy thing, I think, with how it's going. But what it requires is the seller to kind of pester their servicer post-sale to make sure that the swap is done and VA is notified. There's nothing we can do about it. It's not a role that we're involved with. It's just those are the guidelines. So if the seller is absolutely adamant that I have to buy the next day after I close, an assumption might not be ideal for them. So just keep that in mind. All right. Now, another little bit of humor, and then we'll move into closing more deals. They said it would be easy. Being a real estate agent is the least stressful career Jessica, 29 years old, has ever had. She looks like she's not stressed at all for a 29-year-old. And then you go to the doctor. What's your occupation? I sell real estate. Do you drink? Yes, I told you. I sell real estate. So they always make me laugh, whether they make you laugh or not. So, all right, closing more deals. We'll talk about marketing to sellers, marketing to buyers, and then when you get that listing, how you effectively promote it to get the most amount of traffic with it. And then we'll talk about some other resources that have come into the marketplace, and then we'll go into Q&A. All right, so nothing earth-shattering in any of these, I don't think. But marketing to potential sellers, reach out to past clients or your network with assumable loans. Highlight the value of the assumable mortgage in a rising interest rate market. So look at those people that you helped that got the VA and FHA loans. Connect with them. Use social media to educate homeowners on assumable mortgages. You're welcome to link our content to your pages. Those numbers that we went through, I'm happy to go over how we do them, how we calculate them, give them to you if you want them. Create educational videos or posts that explain the assumable mortgage process to the public, showcasing your expertise. That's why you're in this class. You're becoming an expert, right? The more videos and things you can get out there, the more traffic you'll get. Now, use farming tools to identify properties with assumable loans originated or refinanced in the last few years. Market directly to those homeowners for potential listings. Title reps can often help you with this. I will show another thing and another resource that can help you with this as well. We did, when we started in 2022, we started our company, we did a search. We wanted to know in our local county in Colorado Springs, El Paso County, how many VA loans between March of 2020 and March of 2022 had been originated. And in our one county alone, we had 14,000. So that was 14,000 in one county that carried a rate below 3.5%. So across the nation, VA and FHA loans traditionally are about 30 to 35% of most markets. Teach classes to homeowners about the value of their assumable loan in a rising rate market. You're welcome to incorporate the listing presentation flyer that we've created at our website, assumptionsolutions.com, into your listing presentation. It's just a one pager that talks about the asset that they may have. All right. Now, target buyers who could benefit from assuming a low rate loan. Reach out to past clients or your network who may be the most payment sensitive. You could bring buyers back into the market as affordability becomes more challenging. I personally did this. I had buyers in 22, stepped away, and I said, "Hey, look, here's a special option that's out there." And they ultimately found homes. That's all they hunted. Took them a little bit longer in 22, especially because they weren't properly marketed, but it's a lot simpler now than it was back then. Use social media to educate buyers about assuming mortgages, share real examples of payment savings that can be achieved by assuming an existing loan. Feel free to use our examples. Now, that first number column is the one that I think gets most buyers' attention when you start sharing it. Collaborate with listing agents to promote listings, showcasing mortgage and payment details to highlight the benefits of lower rate assumable loans. I know for me, anytime I have a listing, another agent wants to do whatever they can to promote it. I am 100% open to that. I want every listing I have to sell for the most money as fast as possible. And so I would encourage you to do that. Engage with the veteran community, explaining how assuming a VA loan and swapping entitlement with another veteran benefits both parties. Truthfully, a VA buyer with the most entitlement is the most attractive VA person or most attractive buyer out there to a VA seller. Even if they don't care if they do a swap, I'm sure they wouldn't mind doing a swap. So connect with that community. There's lots of resources out there. Host classes about the value of assuming a low rate loan in a rising rate market. You can use our content. And now in our local market, I've actually attended some that have done this and helped them out. So it might be a little difficult outside of our local market. Now, once you get the listing, this is really where I think the rubber meets the road, as they say, right? I didn't realize that agents were not aware of how important it was to properly market what they had. I equate it to, if you took a listing that had been 100% remodeled, had a fantastic view, and all kinds of great things about it, and you didn't take photos and you didn't mention it in any comments anywhere. It's very crucial that you get this stuff out here. So, first thing, use MLS fields for assumable mortgages. Enter details like the loan type, the balance, the interest rate, and the payment. And you can put that stuff everywhere. It's not something to be hitting. It's a fixed asset that is something you should put out there. Our MLS system where we're at had a field for this that was defaulted to no, and most of our agents in our marketplace didn't even know it existed. So check out your MLS there. Now, whenever you can, include the monthly payment in remarks that syndicate to public sites like Realtor.com and Zillow, so you can help buyers visualize their savings. Right now, a lot of those public sites will allow you to go in and edit if it doesn't syndicate out to them, so you can get that information out there. Once again, you can put interest rates. It's not like you're talking about a new mortgage rate that's dependent on somebody's credit and all kinds of other factors. So get that stuff out there. Use social media to showcase the listing, emphasizing the lower payment versus similar homes without an assumable mortgage. Many Facebook groups are out there in many places that you can utilize to post your listing specifically for people hunting these. There's a national one for VA. A lot of markets have local ones. If your market doesn't have a local one, I would create one. We see people joining these groups in mass looking for these. Highlight the assumed mortgage and payment savings with flyers at open houses. Do it on sign riders and put them in flyer boxes. Basically, wherever you can expose it, right? Show buyers and agents also that Assumption Solutions will assist with the process to ensure a smooth closing. You wouldn't believe how many agents are kind of scared of this marketplace just because they don't have any experience in it. And so if you can talk to the other side of the transaction and say, hey, guess what? I have a team member who does this all the time across the nation. They can help us get through this so we can focus on what we are best focused on. That is writing contracts, showing homes, prospecting, helping with all the normal contract functions. They don't have to figure this out. and if they know they have somebody to help them through it. So it's a big help to have us. Now, some of the experts that have come into the marketplace that I think are outside of us that you should check out are well worth your time. Now, obviously, use our website, Assumption Solutions, as a resource. We have a video, this class will be recorded there. We have all kinds of detail about the process, tons of information. But once you get outside of, needing us, right? It's about one, sometimes it's about finding properties that are in your marketplace and getting more clients. And some great people have created these platforms that I'm going to talk about next, that make this a lot more robust marketplace. So the first one is a website called assumelist.com. It was started by a realtor out of Virginia, and it, to my mind, is the most robust platform for finding property across the nation. It is not in every state, however, so check where you're located on their website. But it's a for-pay site, but I use it now as a realtor. When I get a buyer who wants to hunt for an assumable, I build them a search in there for two reasons. It will show every assumable that's on the market in your marketplace, whether it's correctly marketed or not. But the cool thing also about it is it has a little toggle feature, and you can run a search for properties that are assumable but are not yet for sale or not on the market at all. So that's a great prospecting tool that you can use to get listings or reach out to potential sellers directly if you've got a buyer who's not finding the right home. So they got a great tool there. The next, AssumableSales.com, it was started by the people who have the largest VA Assumable Facebook group. Its goal is to send clients who join that group looking for assumables to agents across the nation. So they collect a referral fee for that as well. So both are great tools, both are great options. I am a member of both. I highly encourage it. We don't get any money out of promoting it. We think it's a great resource there. So, all right. I have one last little joke here, and then we'll wrap it up for Q&A. So it's a tough market, but the best agents always find a way. I love real estate agents because no matter what's going on in the world right now, realtors are out there yelling, anyone want to buy a house? And I respect that a lot because I've done that for almost 30 years. All right. I'm going to turn off share here and we can go to Q&A.
All right. So we had some stuff come up in the chat.
Okay.
One was, oh geez, on the FHA mortgage insurance. So after it's assumed, the MI needs to stay on for the duration of the property, regardless of equity. Is that correct?
On FHA, correct. I think it was like 10 years ago, and it probably was a response to the losses of 2008 and whatnot, where they removed the ability to have it drop off at 20% equity for FHA.
Okay. So hopefully that answers that for you, Manny. So yes, after it gets assumed, then it has to stay on, but no if you just have an FHA borrower in a loan that has not been assumed. So hopefully that clears that up. Mortgage insurance. When did the VA loan assumption? Oh, we had a VA loan assumption done a little while ago. Um, Can Craig's company write seller financed notes or guide California sellers on terms such as prepay terms or default terms?
No, we can't advise you on your contract. Number one, we're not being a licensed realtor. I'm only licensed in Colorado. So I couldn't do any, I can help agents in Colorado with regards to contracts, but I could not do that anywhere else in the nation. But I give out information that I think is useful nationwide, but it's an example of in a Colorado contract, like certain terms. Now, with regards to that specific question, I think they were talking about like the owner carrying back a second for the equity and stuff in that
Maybe.
situation. I can't advise whether somebody will do that. I just know that when you go through the assumption, all funds in every situation are going to have to be accounted for, right? Like if the owner is going to do a carryback, that's fine, but the payment and the terms are going to need to be in the calculation for the buyer's qualification, right? And so, but yeah, I can't advise you on terms in terms of your contract. So hopefully that answered that. I do see when we did a VA loan assumption, the lender required the buyer's degree. This was an owner-occupied primary residence. I don't see a date in that. So the investor option evolved into the marketplace. When we started in 22, every single one of the deals that we were involved with had to be owner occupied, both VA and FHA. And then all of a sudden, it was kind of like, well, no, we're okay with that. I think it came out from the VA. Like, truthfully, it was kind of like the Wild West when this thing started. I mean, when we first were doing our first assumptions, commonly they were 120 days. And a lot of the times, we were combating sellers or servicers who didn't even know they had to do them. They thought it was optional or they didn't want to do them and all kinds of crazy stuff. So that's why I have that evolving market slide. Now it is pretty ubiquitous that you can do VA as non-owner occupant. You just have to make sure that the seller is aware that their entitlement will remain with that loan.
Yeah.
So,
And the
um,
percentage you gave for um, owners leaving their VA entitlement with the property was actually a lot higher than I thought it would be.
it depends on where you're at in the nation, I think. If you've got a lot of military in your local marketplace, it's easier to get swaps completed because you've got that pool of buyers who has the ability to do the swap. If you're in a marketplace that has a low pool of VA buyers, but somebody went and used their VA to buy there a long time ago, they might have to consider the leaving the entitlement if it's the only thing that's selling their house. But once again, we see a significant number of people who are just, okay, I don't need it. We've seen some people who, even though they are getting a new house in the future, but they've built up so much equity, they bought the next house maybe even before they sold the new one, right? And
Yeah.
they either paid in cash or they got a low conventional loan and it just didn't matter to them. And so they leave it behind. But the big thing is don't don't assume you know what a seller is willing to do. So
Yeah.
ask them the questions.
So I guess a question on that might come up is, let's say you do that, seller leaves their entitlement there and they're like, yeah, I'm not going to buy again. I'm just going to lay low or whatever. 2 years down the road, they decide they want to buy again. There's no getting that back, right?
Not
From the
until that loan
previous.
is not until that loan is
Yeah.
paid off. Correct. Yeah.
There's no
Now,
petition or anything that they can do.
no, not
Yeah.
not a thing,
All
not
right.
a thing. And I've had questions ask, well, could you put a clause and in there that says they have to refinance it in 2, 3, 5 years or something like that? Just because you put that clause in your contract, how do you enforce it?
I know, really.
Right. I think a lot of these loans are going to go full term. Like
Hmm.
they're going to go the entire 30 years because people are going to see the value. We've had one that we have seen be assumed a second time.
Wow.
Yeah, so they can happen more than once. So I think if you leave the entitlement, you plan to be there. Now, the question that I should talk about that I didn't cover in the slide, what happens to the entitlement in the case of a default? It's permanently affected. So, but I doubt we're going to see a lot of defaults in the assumptions because number one, most of them have pretty large gaps, right? So there's a lot of equity on a lot of these properties. Number two, the buyers that we have seen, my team that processes these, they're multi-decade lenders. They've done more of these assumptions than anybody else. They consistently say that the buyers involved in these transactions are the most well-qualified people they've ever seen come along. And so likely or unlikely that a default will take place. But if it does, that's the purpose of entitlement. Any default affects entitlement. So
Yeah. I can maybe see it on them defaulting on the second if they got a second on it.
Yeah, well, obviously
Yeah. Then you get into some
there's less
challenging
strength.
stuff.
There's
Yeah.
less strength, right? If somebody borrows up to that other 90%, of course.
Yeah.
That's why seconds are risky to the, to the
Yep.
lien
For the
holders.
lender. Yep.
Yeah. So,
All right.
let's see. Is there more that we didn't
Yeah,
cover?
we've got do you give an indication of the buyer's approval up front, or do you need to go through the entire transaction first before you give the buyer's loan approval?
So we don't give loan approval.
Yeah.
I will say that, but we're vetting the transaction. Now, our view is with what we charge, we actually don't make a lot per transaction. So the most valuable thing we have as a company is my processing team's time. And so we're looking as fast as we can to find a reason to say, we can't help you because we don't want to be working on the deal because we've got so many as fast as we can. So that's why I say when we get involved, you send us a contract, we usually have it vetted within 2 days, maybe 4 days, if people get us what we need quickly. Now, we do have a process where by market demand, we'll do what we kind of call a pre-vetting. Essentially, the buyer would pay our engagement fee, send us the same things they would send us in a contract, and we'll look at it and say, would we likely to be able to help you get an assumption completed, right? The nice thing is if they do that, they never have to pay our engagement fee again. So when they finally contract a property, they've already paid it. It's good, right? And then we'll just run the deal through. But most of what we're involved with happens right when you go under contract with when we get involved, because from there we have everything to process. Like we've got what we need from the seller to actually start the whole thing. And the faster we're doing both sides, the faster or the more time saved at the end of your transaction. So
Yeah. Um, is there a
I
website to
see.
find the assumable loans, which you did give? You want to repeat what that website was to find the loans? The assumable loans?
So our website, you can't do any property searching on assumptionsolutions.com. That's great information and connecting with us. But the for pay website that I think is the best site out there for searching for property is assumelist.com. The guy there does all kinds of classes. I think he does video webinars almost every day. They do obviously refer agents to us. They kind of call us the easy button because they make money in subscription fees to people searching property, right? We make money in helping people get through transactions, but we both, as companies, benefit from more transactions in the space. So we're very synergistic in that way, but we don't own each other. So
Okay.
um, let's see.
Could you please give us an example of buyer qualifications for the assumable FHA loans where buyers are not otherwise VA qualified? Okay, they have.
I mean, the qualification standards for either VA or FHA are the same for an assumption as they are for a new loan. They might be a little tighter for an assumption because most of these actually go through a manual underwriting process. I mean, if you want to hear a lender brag, they'll talk about, hey, I was able to get so and so finance at a certain high level DTI, right? They can do that in a lot of cases through automated underwriting, but with manual underwriting, you have kind of the letter of the law standards that you need to follow. So they might be a little bit tighter in terms of that. We've seen a little bit of flexibility in what we've processed as far as DTI, but not crazy. I mean, you're going to be qualifying to the standards of either loan. It's just with FHA, it must be that you are going to own or occupy that property. VA, obviously, you can do it as an investor if entitlement is left.
Now, on the investor route on the VA, they're going to have to be a full doc loan still, right? Because not all investors are.
No, correct.
So
They're
it can't be a
going to
non-QM, right?
no, they're going to have to go through it just like a owner occupant would.
Hmm. So W-2 income, all that, tax returns,
All,
all that.
all, all of the lending colonoscopy.
Yep, exactly. All right. Is there any risk to the buyer in buying who is not a VA assuming a VA loan?
None. I mean,
It's actually worse for the seller. That I think the risk is
I
on the
mean,
seller.
you're always released from liability on the loan in an assumption. These
Yeah.
are not subject tos, which I think you should run from and not touch with a 10-foot pole personally. But they're always released from liability. In the VA situation where entitlement is left, the only thing that is affected one way or the other is their ability, the seller's ability to do future VA loans, either eliminated or just reduced by the amount of entitlement that's remaining on that old loan. So for the buyer, though, I mean, the risk is you don't make your payments and they come take the house. That's the biggest
Yeah.
risk. So
Yeah. Nothing
now,
new
if you
there,
if you
but
went in, if I will say, if you went in and said I'm owner occupying this, right, and then never moved in, that would be a problem. Now, that doesn't mean that you can't owner occupy and then turn it into a rental in the future. I would definitely do that. But while there's no specific guideline on time, I would say you want to live there at least a year would be my recommendation. So,
yeah. All right.
okay, I
Yeah.
think I think we
I
covered
think
them all.
I think we covered them all. So appreciate your
Okay.
time. That was good. These
Yeah,
questions are gonna pick up a little more. So
we're just under the hour here. I will say I'm
perfect.
very easy to reach.
Yep.
AssumptionSolutions.com. It's got our phone number. If you call that number, it rings right here at my desk. If you send an email, it comes directly to me. I'm kind of the shield for the processing team. Once you've got a deal going, you're never going to talk to me. You're going to deal with one processor all the way through the process. And every time we get a good Google review, I'll be honest with you, they're not reviewing me. They're reviewing my team, who are absolutely awesome. So feel free to reach out. We're here to help you be a success.
Awesome. Well, I appreciate your time. That was real informational. And we'll have the replay up. And then again, if anybody needs the number, let us know. We'll probably go ahead and throw it in our back office too, under the transactional needs stuff, and so you guys can find it a little more easy. Next month when you said, I remember doing a webinar, but I don't remember what it was. We'll go ahead and put it back there so everybody has it. So, all right. Well, I
All
appreciate your
right.
time. Thanks for coming on.
You got it.
All
Thanks.
right.
Have a great
Hope everybody
day.
has a great week. Okay. We'll see you.